Good morning. Thank you for joining me. Appreciate it here on the podcast. It's Sunday morning, and I wanted to get this out to you just to kind of recap where we've been. As I've said before, sometimes it's easier on the weekend to get these done simply because markets are closed. But 3 of the days last week were these 90% down days. Now, in the previous podcast, we talked about a couple of them, but there was actually a third one. It was that reversal day. So we had these 90% down days where you have 90% of the stocks down, the volume down. It's just, and there's a lot of technicals with it, but the bottom line is that it's very one-sided. It's very lopsided, and it shows that there's pretty much mass distribution. Everything's going down. Everything's moving the same direction. And when you get those, while it definitely is a bad thing, a few of those together within a short amount of time, followed by the opposite, where you have a lopsided up day or 2 or 3, shows you sometimes that we are at a bottom. So the red arrows are the 3 90% down days. So 3 out of 4 days were 90% down days. We reversed intraday on, I guess it was, Monday of last week. So the market went way down the middle of the day. It reversed. I talked about in our aggressive models buying some mid-cap ETF, and we thought that had fallen far enough, and we did get this bounce. Now, again, what you're trying to see is, after that, is that buying really intense? Are we getting the same type of intensity on the upside that we got on the downside? And the short answer is no, we did not. Longer answer is we got some good buying. First of all, we did have the reversal, and we had a couple of these 80% up days. So they were days that were, on balance, pretty strong. They just weren't, as strong as the bad days were strong on the downside. So it wasn't quite the V we were looking for, but it was good. What I would say at this point is that, number one, and I've got all these lines, and I would love to take them off, but I think they're important. Number one, you can see we broke this trend we'd been talking about. And we had some of these levels drawn on here prior, and we actually bounced right on one. And it was around the 100-day moving average. Now, some people believe that buying was just simply we were oversold. We were going into the quarter end, some window dressing, and so we got 3 up days. And then it paused on Friday. And that very well may be the case. In fact, if you look, where did we stall? We actually stalled right at the 50-day moving average, which is interesting. So the market was going up, hadn't really fallen below its 50-day moving average, which is the blue line, and fell below it, and now it's touched it on the underside of it. So it is at a point, it's at a very important inflection point where it didn't get above it, and so it could just fall back down, and the correction continues. Obviously, any further strength would take us back above it and give the bulls another chance. I think right now, because it's a 50-50 proposition, I would err on the side of being cautious in the next few days. Let's let the market prove to us over the next few days, or investors prove to us, that the buying we saw at the end of last week was real. You're starting to see some of the backtracking by the Fed, and whether it's intentional or not, I'll let the conspiracy theorists discuss that. But Bernanke says, here's my exit strategy. If, right? He had a bunch of contingents. If this, if that, then we'll scale back our purchases. And lo and behold, the market freaks out, has this temper tantrum, or taper tantrum, as it were. And what happens? Well, the various Fed presidents come out during the week and say, the Fed's not even anywhere close to doing this. Our balance sheet's going to stay large. And there was a relief rally in a lot of those income-producing things that got hit the hardest. Bonds, REITs, high-yield bonds, all types of things went up very strongly after those Fed presidents spoke. And so, again, was it intentional or not? Who knows? Bottom line is, they laid out their plan, and the market is going to go through an adjustment period. Now, this adjustment period is kind of analogous to my 11-year-old son. Now, he's old enough now to ride a bike on his own, right? He's 11 years old. But I remember a story one time when I took the training wheels off of his bike one day, and I said, look, let's give this a try. Let's try to ride this bike without the training wheels. And, he had a little bit of a temper tantrum. And, I think, and I told him, hey, look, I'm not going to let go of this bike until I am 100% confident that you can ride it without my support, right? I'm going to hang on to the back. But he doesn't fully believe me. He doesn't trust me, right? And so what happens is, this is the story of the interaction between investors right now and the Federal Reserve. Ben Bernanke says he's not going to end the tapering, which is analogous to letting go of the bike, until he's certain the economy is stable enough to handle it. Now, over time, my son gained confidence, and he knew that, hey, I'm not going to let go of the bike until he was ready to ride it. And once he did, I let go of the bike. Everything was fine. But it took an adjustment period. It took some trust building on both parts. And I think that's what's happening right now with the markets. They're saying, look, we hear what you're saying, but we don't believe that you're going to be there for us if the economy struggles. And he's saying, yes, I will. And I think we should listen to them, because the evidence is that they will not taper until they're confident that the economy can withstand some of these little blows, and it can hold up on its own. And so, but the market's going through that adjustment period right now. So you're seeing the volatility pick up quite a bit. In fact, you see in the last, a couple of weeks here, volatility had spiked up over 20. I guess the high was 20, almost 22. We're back down to 17 now. So we had this spike. Everything was oversold in the short term. It popped, and now we're at this period where bonds have rallied just a tad. You can see this is the TLT. It's a 20-year Treasuries. After this big sell-off, they rallied the last 4 days. We've had, stocks rally, and we've had bonds rally, but now we're at this inflection point. So I would just say, and again, trying to keep this kind of short, I would just say that the stock market right now is at a point where it's a prove me. And you can see still some of these things are stuck. The NASDAQ stuck in between some of these moving averages. Tech was actually up on Friday, even though the Dow and the S&P were down. Kind of a mixed bag on Friday. But I would not make big bets one way or the other here. I would say that I would pick your battles. I would buy some things that look interesting, especially some of these things that have sold off in the income space. But also, don't get complacent and think that was the sell-off is over. We had the 6.5% correction. It's over. I think you should be positioned to have some places where you would buy. What would cause you to buy, whether higher, and it's okay to do that. For example, it's okay to, if you're wondering, to say, well, I'm going to wait until, let's just say that this trend line that I've drawn here, I'm going to wait until it breaks above that to buy, but I'm also going to wait to sell until maybe what did it do last time? It bounced kind of off this 100-day moving average. So what if it falls back through there? That will cause me to sell. So you're kind of using this approach where you're buying if it confirms it, and you're selling if it confirms it. But while we stay in the middle here, and we kind of stay within this box right in here, you're not going to do anything. That's okay. You have things that are paying income, hopefully. You have some cash. But just keep in mind that this market is still very, I think, number one, the data is still going to be mixed on the economic front. New home sales are still doing very well. If you think about what's happening right now, if you look in the very big picture, unemployment is declining slowly. There's a lot of problems with that we've talked about with jobs, but unemployment's declining. People eating out is going up. People buying cars are going up. People buying houses are going up. People refinances is going up. So is it appropriate for the Fed to say we want to adjust or to start to taper when we see evidence that the economy is okay? Yes, that's what we want. We want the Fed out of the way as soon as possible. But I just don't believe the data is strong enough for them to get out in a quick fashion. I hope I'm wrong, because if I'm wrong, that means the data will be, and the economy will be better than we thought. But in the meantime, I think the volatility may continue for a while, so you're going to have to put up with some of that because, look, I mean, if you go back, if you look at the S&P here and we kind of zoom in, if you go back about 15 trading days, we're right back where we were. We bounced, we went way up to over 1650. We went down as low as 1560. It's a 100-point swing, and now we're back in the middle. So what did volatility do? Well, it made you a little nervous, but we just go back to where we were 15 days ago, assuming you haven't positioned anything differently and assuming your stuff correlates with the S&P. But the bottom line is that the volatility has picked up, but we haven't really moved anywhere. So again, wait for the market to confirm what it's going to do, one way or the other. Now, before we end this, and I know it's a very, very short one, but I just wanted to, again, just give my update on the market and kind of where we are technically. And again, I think bottom line is we need to cross above this 50-day moving average because that's kind of in the line in the sand. But let's take a look real quick at gold, and we'll just pull up the GLD since it's the surrogate for gold. You can see it's broke through this. A lot of people are wanting this inverse head and shoulders, broke through. That's heading straight down. Why is that? Well, again, if they're going to, there's a couple of different theories out there. Number one, that the economy's growing and we don't have any inflation and there's not a bunch of fear out there, so gold should be sold. Other countries may be selling gold. Their demand's down because they're struggling. China, India, places like that. Or the country's selling their gold reserves because they need the money. There's lots of reasons for this. But here's the thing. If you look at gold since 1975, there's been about 14 bear markets, which a bear market means 20% decline or more. Now, the average one is about 33%. Okay, so this one that we're experiencing right now has been 35%. It's been a little bit more than the average, and it's been a little longer than the average. It's been about 600 days. The average bear market in gold lasts about 483 days. And the longest bear market was a period of about 16 years, from like 1987 to 93, and where gold fell about 34%. The shortest was 1 month. In 1978, it fell 23% in a month. So we've had some, this bear market we're going through right now it's right at about the average. So, looking back at history, big asset allocators are always looking for deals, and it's a mean reversion game. So, for example, when you think of stuff like emerging markets, which we touched on last week, and we said that this point here could have been an interesting trade, and it has turned out to be so, but it may be a very short-term trade. It was a very risky one, but it could be a good trade simply because we go back, and I'm going to change this to weekly. And you can see this has been a kind of a place since 2010, 11 that we've bounced several times on EEM, which is an emerging markets ETF, about 36, we'll call it 36 and a half or so. That's where it's bounced, and it bounced this week pretty strongly, and we've had about a 7.5% jump since then. So could emerging markets outperform the developed markets for a while? Could we see gold stocks like we have GDX, which is the gold miners, had a big reversal this week and was up about almost 8% on Friday on very, very heavy volume. So some of these things could rally that have been underperforming. So you could see things like bonds, REITs, emerging markets, gold miners. Those could be the strongest thing for the next couple of weeks. Who knows? While some of the things that were the strongest, i.e. Japan, some of those things the past few weeks, even oil, could start coming back down. So again, watch for some of this rotation, but really what we want to see, if you're a bull, is you're wanting to see follow through, but you're also wanting to see what's working the best. Is it just the consumer staples and healthcare, or is it things like financials? Is it things like emerging markets, technology, industrials, materials? Those are the things that would show you the risk is really back on and people want to get invested. So it's the quality of these rallies that matters, and looking underneath the hood of what's working, not just the major indices. That doesn't help you. In fact, if you look at the Dow Jones on Friday, it wasn't quite what it revealed. IBM was accounted for probably half of the points lost on the Dow on Friday. So the Dow was down 115 points, but a lot of that was because IBM is a very high-priced stock the Dow's a price-weighted index, and so IBM accounted for a big portion of those points. That's why you saw the S&P only down 0.4%, the Dow was down 0.8%, and the NASDAQ was actually slightly positive on the day. So you have to look at the weightings of these. But anyways, that's about what we have for right now. Of course, we're going to have a holiday shortened week. The market closes at noon on July 3rd, and then on July 4th, we will be closed for the whole entire day for the 4th of July Independence Day. And so those sometimes are good days as far as some of these holidays, as far as trading being up. Keep in mind, we're at the beginning of a new quarter, so we could see some volatility. And again, just watch and wait and see which way this thing goes, and then see if it's a pattern. But right now, we had the reflective bounce, but we have not seen the follow through just yet. But it wasn't a horribly weak rally. Those 3 days we had in a row were good. They just weren't as good as the bad ones were bad the prior 3 or 4 days. All right, guys. Hey, don't forget, keep the questions coming. KarlEggers.com, through TradersEyes.com. We're on iTunes, Facebook, Google+, EggersCapital.com as well. We're on Twitter, @KarlEggers. So check all of those out, and have a wonderful rest of the weekend.